it's interesting. When I first got into the real estate space, it was on non-performing side. So I feel the pain. You're right. It's a very active space that you have to be in. I mean, you're a therapist. You're, your accounts receivable. You're trying to get those payments. You're the legal department. It's all kinds of things that you're doing when you're trying to tackle those. But you're right. I mean, so you can share your discount with people, and help modify them into performing or help them pay it off. What I found, I wondered if you found this as well. Most of those people who were not performing had the ability to pay this. They chose not to because the banks that they were working with chose not to work with them. So they got really pissed off and just stopped paying. I was shocked how many times I would talk to people and they're like, we can do like more or less a short sell or a discounted payoff, or we have the money to do that, or we can resume payments at a slightly discounted rate. Is that what you find as well with most of these, or what are you finding?
Yeah, most people, even attorneys that I would run across, not the foreclosure attorneys, because they were educated in this foreclosure space, but most regular attorneys or real estate attorneys or regular business attorneys, they didn't even understand the concept of it. They thought if you was to initiate foreclosure from second position, you have to pay off the first mortgage, right? That's just, most people think that. So the homeowners had that same mindset that I've learned in the borrower management process, that they didn't think we would pay off the first. They thought we had to pay off the first if we foreclose, and you don't. You can foreclose subject to the first mortgage if you have to go down that route. Our business model was, if we foreclosed, we failed. We wanted to work something out with the borrower. We wanted to share our discount with them. Now, if they stuck their head in the sand and didn't pay us, we have investors to answer to. So obviously we have to go down that path. But that's just one part of the business. You don't have to do borrower management when you buy seconds. I know a lot of successful funds that just turn paper. They buy it at X and sell it for Y. And basically that's their model. They don't do any collections at all. That's the collection part is really expensive. Borrower management and legal. I always make a joke and say the attorneys make more money in this space than I do, because of legal and everything else. But you can have that model where you just turn paper. There's a lot of successful funds that just buy it in bulk and they carve out stuff that they want and they sell off the rest. We always make a joke that second mortgages are the orphans. So if they buying a pool of first, maybe some HELOCs may come with that, or maybe some, at the time, those are HELOCs or home equity line of credits. They will scrape all that stuff out. Or the low balance loans, anything less than $50,000. Maybe it's in places like Alabama, Ohio, or certain states, certain parts of PA where there's low balance loans. The big boys don't want to deal with that stuff. They'll just carve that out and sell it. And so you get some of that stuff with second mortgages also. And that's what actually introduced me into first, when I started to level up and have a fund and raise capital to be able to take down more loans. I started to see that I was getting first mortgages, low balance first mortgages, which is a whole different space. But I like seconds, again, for the reason that it gives me an option on the property. And, it's unprotected by the first. The insurance that the first mortgage had, when they make that first mortgage payment, insurance, taxes, and everything is included. So I don't have to pay any of that. If I buy a first mortgage, now I have to put forced place insurance on it. And I have to do other things. Due diligence is more expensive. So it's just two different concepts. Both are great investments, but seconds is definitely a business.
Well, if you're operating a fund that has a lot of capital, it makes more sense to, buy by the case, sell by the bottle, so to speak, and then just make the spread on what you're going to sell these notes for. That's a very efficient model if you have enough capital to do so. And frankly, the places that are selling these notes would rather sell off a big chunk of it than have to, sell individual notes out to folks anyway.
Correct.